Why is understanding how businesses are valued important, even if you aren't thinking of selling? To start, it's helpful to understand how a business is valued from a mathematical point of view. It is generally determined by two key factors, cash flow and a multiple. Before we go further, it's useful to understand what the multiple means. Essentially, if we're buying or selling a business, we are buying a stream of income. The multiple reflects how much we are willing to pay for that stream of income. There are two basic issues that determine the multiple. One is the time value of money, and the other is the risk associated with the future cash flows. The concept of the time value of money suggests $1 tomorrow is worth less than $1 today. When we layer risk on top of that, it is worth even less. So if I lend money to the government, I am reasonably assured I will get it back. Therefore, the only compensation I need is to pay me for not consuming today but consuming tomorrow. So that is the time value of money, as well as any perceived inflation risk. In today's economy, that rate is quite low at 1 to 2%. The government rate is referred to as the risk-free rate, which is typically the lowest rate in a market. If there is any doubt whatsoever you will get your money back, you will demand a premium. If you think there is, say, a 1% default probability of a corporation, you will want a higher interest rate, say to 3 to 5%. If you're lending on real estate, you will factor in all the risks related to the project and demand a rate reflecting the fact that while secured with the real estate, it is not risk-free. In terms of risk, the lower the risk, the higher the multiple, because the more assurance you have that a certain cash flow could continue forever, the more you would pay for it. So if we compare multiples available in our current economy, you can buy virtually guaranteed government bonds for a yield of 2%, which translates into a multiple of 50 times. Or you can buy blue chip stocks that include a dividend and some growth for a multiple of 10 to 15 times. Or you can buy various types of real estate assets for multiples of around 10 to 15 times. Or you can buy a private company for an EBITDA multiple of 3 to 5 times. Where you fall in that range is the subject of our next session.